Hello, I'm Joseph Graff. This video is one part of a 500-part video series where I analyze the 500 largest companies in America. If you'd like to check out my other videos where I conduct stock analysis on other companies, I will include the link in the description. Also, I'd like to say that if you enjoyed today's video, please make sure you hit the like button and subscribe to the channel. Also, hit the notification bell so you'll be notified whenever I post future updates. Lastly, I'd also like to talk about M1 Finance. M1 Finance is running a great promotion right now where if you sign up using my referral link, we both receive $10 that we can use to invest in the stock market. I'll include my referral link below. Thank you all for watching, and here's the video. Johnson & Johnson was founded in 1886 by three brothers who founded the company to sell bandages and dressings for wounds. Johnson & Johnson specializes in medications, beauty supplies, and first aid. Some of Johnson & Johnson's most well-known products include Tylenol, Benadryl, baby shampoo, and Listerine mouthwash. Johnson & Johnson has three main operating segments, which are pharmaceutical, medical devices, and consumer products. In 2019, Johnson & Johnson's largest segment was their pharmaceutical segment, which was responsible for over $42 billion in sales. Sales have stayed pretty steady for Johnson & Johnson across all three segments in recent years, with all three of the segments growing at roughly the same rate. Johnson & Johnson is currently the seventh largest company in America, valued at $400 billion. In this next slide, I will be talking about earnings and earnings growth. These two metrics are important because they are the driving force behind a company's valuation and thus the company's stock price. Companies usually report their earnings every quarter. Large, stable companies tend to have positive earnings, while companies with high growth potential may operate at a loss in the hopes that they will become profitable in the future. Understanding a company's earnings and earnings growth goes a long way in being able to accurately value a company. In 2014, Johnson & Johnson stock earned $5.70 per share. In 2015, they earned $5.48 per share, which was a 4% decrease from 2014. In 2016, Johnson & Johnson earned $5.93 per share, an 8.2% increase from the previous year. In 2017, Johnson & Johnson's earnings per share jumped way down to 47 cents per share. This was a 92% decrease from the previous year. In 2018, their earnings jumped back up to $5.61 per share, which was an increase of over 1,000% from the previous year. In 2019, their earnings stayed consistent and in line with previous years at $5.63 per share, which was a 0.3% increase from the previous year. This data indicates that Johnson & Johnson's earnings have stayed pretty steady for the past 5 years. The only outlier was 2017 when they earned 47 cents per share, and after doing some further research, it turns out that they incurred a large expense due to some changes in the tax laws. Now that we've looked at the company's earnings, we will now talk about its price to earnings ratio, also known as PE ratio. PE ratio is calculated by dividing a company's price per share by its past year's earnings per share. Generally, companies with low PE ratios are considered value stocks, while companies with higher PE ratios are considered growth stocks. PE ratio is a useful metric for understanding how Wall Street feels about a stock. In general, a stock with a PE ratio under 15 means investors are somewhat pessimistic about a company's future, while a PE ratio above 30 indicates that investors are optimistic about the company's future. As of April 28th of 2020, Johnson & Johnson was trading at $152.28 per share. This represents a trailing 12-month price to earnings ratio of 23.78. This is a little bit higher than the trailing 12-month price to earnings ratio of the Standard & Poor's 500 at the time, which was 20.8. In this next slide, I will be talking about the company's price to earnings growth ratio, also known as PEG ratio. This ratio is calculated by taking a company's PE ratio and dividing it by the company's growth rate in terms of a percentage. It is generally thought that companies with a PEG equal to or around 1 are fairly valued. Companies with a PEG above 1 may be overvalued, while companies with a PEG ratio below 1 may be undervalued. PEG is a popular metric among many investors because it takes both a company's earnings as well as earnings growth into account. As of April 28th of 2020, Johnson & Johnson was trading at $152.28 per share. This represents a trailing 12-month price-to-earnings growth ratio of 2.9. This metric indicates that Johnson & Johnson may be overvalued if you use this metric solely to value the company. In some of my previous videos, I've mentioned how sometimes this metric is not particularly useful, but in this case, I think it is a very good metric to look at and something important, and what it really shows is how little Johnson & Johnson has been growing in previous years. In this next slide, we will go over the company's dividend yield, dividend growth rate, and dividend payout ratio. Dividends are generally a sign of a healthy, profitable, mature company. It does, however, indicate that the company feels it has limited growth prospects as the company is choosing to pay cash to shareholders rather than reinvesting it into growth opportunities. Dividend growth rate is the rate that a company grows its dividend payments year over year. A high dividend growth rate is usually seen as a positive to investors. Dividend payout ratio is another important metric. It represents the percentage of a company's profits that it pays out as dividends. A payout ratio below 60% usually indicates that the company's dividend is safe and has room to grow in the future. A payout ratio above 100% means the company will almost certainly cut its dividend, as that means that the company is paying out more in dividends than it is earning. Johnson & Johnson is pretty well known for its dividend payments. As of April 28th of 2020, Johnson & Johnson offered a dividend yield of 2.65% as they paid $1.01 per share per quarter. Johnson & Johnson most recently raised their dividend in April of 2020 when they increased it from 95 cents per share per quarter to $1.01 per share per quarter. Johnson & Johnson over the past 5 years has increased their dividend by an average of 6% per year. Johnson & Johnson's dividend payout ratio is currently at 44% based on their past 12 months of earnings. This indicates that they should be able to sustain this dividend payment in the future and likely will be able to grow it in the future. Another interesting note about Johnson & Johnson is that they have continued to raise their dividend at least once a year for the past 57 years, which is amazing. In this next slide, we will be going over the company's price-to-book ratio as well as its debt-to-equity ratio. The book value of a company is essentially the value of all of its assets. Book value per share is simply the book value divided by the number of outstanding shares. Furthermore, the company's price to book is just its price per share divided by its book value per share. This metric can help you understand if a stock may be undervalued or overvalued. A company's debt to equity ratio is calculated by taking the sum of all of its debts or liabilities and dividing it by the total shareholder equity. In general, companies with a lower debt to equity ratio are better equipped to withstand an economic downturn. Debt, however, can be used by companies to grow and expand, which is why a high debt to equity ratio is not necessarily a bad thing. As of December of 2019, Johnson & Johnson had a book value per share of $22.60. This represents a price to book ratio of 6.74. As of January 2020, Johnson & Johnson had a debt-to-equity ratio of 0.46. This is on the lower end of debt-to-equity ratios for Standard & Poor's 500 companies, and it indicates that Johnson & Johnson would probably withstand an economic downturn pretty well. In the next slide, we will look at the company's 3-year, 5-year, and 10-year return. A company's past performance does not predict its future performance. However, it does allow you to see how a company has done in recent years. In general, a steadily increasing stock price indicates a company has been operating successfully. If you had bought Johnson & Johnson stock on April 1st of 2017, held it for 3 years, and reinvested all the dividends you received, you would have seen an average annual return of 3.8%. If you had bought Johnson & Johnson stock on April 1st of 2015, held it for 5 years, and reinvested all the dividends you received, you would have seen an average annual return of 8.8%. And if you had bought Johnson & Johnson stock 10 years ago on April 1st of 2010, held it for 10 years, and reinvested all the dividends you received, you would have seen an average annual return of 10.7%. In this next slide, I give my grades for this stock. I'll include grades for how I feel this stock is as a defensive investment, a growth investment, as well as an overall investment. My defensive grade takes into account how well I think the company would do in an economic downturn. My growth grade for the company takes into account how much I expect the stock to grow in future years. Finally, my overall grade is my personal opinion on the stock and whether I feel it is a buy or a sell. Keep in mind that these are my own opinions, and I am not recommending you purchase this stock or make any investment without doing your own research. As a defensive investment, I gave Johnson & Johnson an A. Johnson & Johnson has increased their dividend at least once a year for 57 years. This company has been around for over 140 years. I feel confident that this company will continue to do well, especially with how diversified they are and the products they sell. They have a lot of products that are hard to imagine life without, such as baby diapers, as well as many different drugs such as Tylenol and Benadryl. As a growth investment, I gave Johnson & Johnson a C-. Honestly, I just don't feel like Johnson & Johnson is a stock you'd want to invest in if you were looking for a lot of growth. Like I mentioned earlier, this company has been around for 140 years. Their earnings have been pretty flat over the past 5 years, and I just don't see a lot of room for them to grow. Now, they do have a medical devices division, which I expect some growth out of in the near future, but overall, when I think of a growth stock, Johnson & Johnson is certainly not the first stock that comes to mind. As an overall investment, I do like Johnson & Johnson. I really like their dividend payout track record, how they've raised their dividend at least once a year for the past 57 years. I think they're a strong, solid company, and I think they make a pretty good investment in my opinion. That'll wrap up today's video. If you enjoyed the video, please make sure you hit the like button down below and subscribe to the channel. I'll be doing this type of video for every stock in the Standard & Poor's 500, so keep your eye out for future videos. Thanks again for watching and take care.